Plan Investment Board a bloated organization. He said higher operating costs did not result in adequate payoff for the 18 million plus Canadians that pay into the plan. That column was quickly rebutted by pension expert Keith Ambitshire. He argued the CPP's new strategy was working just fine. We thought we'd bring the two on to make their cases to us. They're both here. Keith, Andrew, let's start with you. You opened this can of worms. At issue, though, is this whole notion of maybe it is bloated, but it's getting good returns. Are the returns what matters, or is the management of the fund sort of integral to what we have?
Well, they're not getting above market returns, and I'll come back to the point. Yeah. Let's focus on the costs. First of all, I'm far from the only person who's been concerned about it.
Sure.
I've had emails from people within the organization who are worried about it. They went from a staff of 10 years ago to a staff of over 1,200 now. At the start, the founding CEO was paid $300,000. The average salary in the executive suite now is over $3 million. Their costs are now over $2 billion. All of this in pursuit of active management, of trying to beat the market. Well, when you look, even using their own benchmark, and I'll come back to that, they're barely exceeding it. It was about 0.3 of a percentage point until last year. Now it's about 0.8 of a percentage point. But they've spent billions of dollars in pursuit of that largely chimerical gain, and we can discuss why that's the case. But their benchmark is bogus as well. The benchmark is based on publicly listed stocks and bonds, and in fact they've been plunging heavily into much more risky private markets.
Yes.
Which they're fine to do, but you should use a comparable benchmark. So the fact that they've slightly exceeded a benchmark that is much less risky than the actual portfolio they hold shouldn't be cause for great celebration.
And Keith, you wrote back in to say an open letter to Mr. Coyne to say, well, wait a second, let's look at sort of how the fund is performing. What do you say to that? That he says it's not meeting by its own benchmarks.
So if you start at the macro side, I think there are basically three choices for how you can invest this kind of money. One, I would say, is a not so good way. You can call it beauty contest investing. You can call it playing the loser's game of basically trading with each other, spending a lot of money that way, and in the end you end up with market returns less costs.
Yeah.
So that's one, and sadly a lot of money managers, even professional ones, that's the choice they make.
Sure.
A second approach that Andrew mentioned is actually choosing not to play the game, which means you're 5 basis points and you're just basically riding along and let everybody else do the trading and you're just holding.
Yeah.
The third approach is to proactively decide that you're going to assemble an expertise group and engage in the market and buy cash flows at prices that meet some standard, to hold those cash flows for long periods of time, and to basically assemble a diversified portfolio of cash flows, and to operate in that way. Very few organizations choose the third route.
And CPP
has chosen that route.
But it's active management. It's attempting to beat the market.
Which report after report after report.
I'm sorry, Andrew, but there's two kinds of active
study after study.
There's two kinds of active management.
Just let Andrew voice his and then...
Study after study, year after year, has shown 2/3 to 3/4 of active management.
Right.
I'm not talking about the rubes who don't have information. I'm talking about professional money managers trail the market. Okay, that's not because they're dumb or they're stupid. It's because they can't beat all the other smart, well-informed managers who are out there. That's as true for the CPP as it is for anybody else. The only way you get higher return is not by being smarter picking stocks, it's by taking on more risk.
No. Well, and I think the third dimension in this that changes the conversation is time horizon. A lot of these trading games are played on 6-month cycles. Once you choose that you're going to be in the game a long time, that you can afford to buy cash flows, which, by the way, even though they're private, may not be any more risky than a publicly traded cash flow.
Yeah.
If you choose to go that way, then some of the things that are risky for these traders is not risky if you're a long horizon investor that has a positive cash flow coming in for the next even 10 years.
The point I wanted to get at, that you brought this up, Andrew, the private fund managers went from $25 million in fees from the CPPIB to $947 million in fees between 2007 and 2014. At its base, is there not a case to say the board is too bloated, that it has taken on just sort of too much?
Well, I'm not on the inside.
I get that,
right?
For sure.
The reality is they're now up to 7 offices in different places.
Yeah.
If you're going to play the private markets wealth creation game, you've got to be on site. You've got to make the investment in the people and the locations to be a local player in different places. So that's part of the strategy.
The founding premise when the CPP went into the marketplace in the late 1990s was it was going to be passively managed. That was the understanding in which everybody signed off on. And somewhere along the way, the managers of the CPP managed to sort of wriggle out from under that. They have made out very well for themselves. They've made millions of dollars. Maybe Keith is right that 50 years from now they'll find out that we'll find out they were geniuses, but maybe we won't. And by that time they'll have retired with their money.
Long gone.
They'll be gone.
Right.
Keith, we only have about 30 seconds left. What do we do going forward? I mean, how do we ensure that we're
what I would say is I was there at the beginning when this started, and at that time the passive approach was absolutely the right thing to do because there were no resources, and it was the only thing you could do at the time. But over time, with the buildup of the assets, you can make the choice to be active. The research shows that this style of investing by the people that practice it long term do in fact generate net positive rates of return.
I would beg to differ on what the research in fact shows on that.
Well, I've done the research.
Okay.
I've read the research.
Well, listen, I appreciate you both coming in. I think it's a hugely important subject, and I hope we can turn the show into a place where we can have respectful debate and reasonably disagree, and I think we'll have to leave it there. So, Andrew Coyne and Keith Ambigure, thanks to both for coming in.
Okay, thank you.